Most investors hear hard money loan and immediately think, that sounds risky. That sounds expensive. That sounds like something you use when nobody else will lend to you. That's backwards. Hard money loans are one of the most powerful tools in a real estate investor's toolkit when you know how to use them. And in this video, I'm going to break down exactly what they are, how they work, and when they actually make sense. Welcome to Clear to Close REI, where we make real estate lending make sense. I'm breaking down every loan type so you can stop guessing and start making smarter financing decisions. All right, let's talk hard money. Here's the one-sentence version. A hard money loan is a short-term loan secured by real property, where the lender cares way more about the property than about you. That's it. That's the whole thing. Traditional banks spend weeks analyzing your tax returns, your W-2s, your debt-to-income ratio. Hard money lenders look at one thing, the deal. Specifically, what is this property worth after repairs? That number is called the ARV, the after-repair value, and it drives almost everything. So who uses these loans? Fix and flip investors. That's the sweet spot. You find a distressed property, you need to close fast before someone else grabs it, and you need short-term financing to buy and renovate it. Hard money is built for exactly that scenario. Let's walk through a real example. Say you find a beat-up house. As is value, $80,000. After you renovate it, it'll be worth $150,000. You've got a $30,000 renovation budget. A hard money lender looks at that $150,000 ARV and lends you 70% of it. That's $105,000, enough to buy the property and fund most of the renovation. 6 months later, you sell for close to that $150,000 mark. You pay off the loan, you cover your interest and points, and you walk away with a real profit. No bank would have touched that deal. And even if they would have taken 60 days to close. You'd have lost the property. Now let's talk numbers, because this is where people get scared. Hard money is not cheap. Rates typically run somewhere between 10 and 15%. You'll also pay origination points, usually 2 to 4. 1 point equals 1% of the loan amount. And terms are short, 6 to 24 months, with a balloon payment at the end. Here's how to think about it. You're not buying a 30-year rate. You're renting capital for 6 months to execute a deal you couldn't otherwise execute. When you frame it that way, the math often works. But here's the part most beginners miss. Hard money lenders don't just look at how you're getting in. They look at how you're getting out. That's called your exit strategy. Are you going to sell the property? Refinance into a long-term loan? Pay it off with cash? Your lender wants to know. Because if your exit strategy falls apart, that balloon payment comes due and you're stuck. So before you take a hard money loan, know your exit, know your timeline, and build a cushion into both. A few more things to know. Hard money approval is faster than anything else in lending. We're talking days, not months. Your credit score matters less, though lenders still look at it. Your income documentation is minimal, and because it's asset-based, self-employed investors and new investors can access this product when banks would say no. The trade-off is cost and timeline pressure. High rate, short term, and a lender who is watching your project timeline closely. Used right. Hard money is a speed tool. It lets you move faster than your competition, take on deals that banks won't touch, and execute a strategy that generates real returns. Used wrong. It's expensive short-term debt with a deadline you can't meet. Know the difference, and you'll know exactly when to reach for it. If this helped, hit subscribe. We drop a new lending breakdown every week right here at Clear to Close REI. Next up, we're covering how to actually fund your first fix and flip from start to finish. Don't miss it.